What's up, everyone? I'm Paul, co-founder of Cryptoversiti, here with my partner and lead researcher, Jason Sondels. How you doing, man?
Well, I'm doing great. How you doing today?
Man, I can't tell you how pumped I am to be here with you. I've been looking forward to this day for a while. We're launching Cryptoversity, and I'm really excited.
Me
Uh,
too. Me too.
just so you guys know, Cryptoversity is the college of crypto. We teach you everything about the basics of crypto. It's launching soon. We're really excited for it. In the meantime, we're going to be doing daily YouTube videos, talking about trending topics, upcoming projects. You name it, we talk about it. My man, I've known you for 15 years. You got me into crypto. You've been my mentor for the last 5 years, and I have a lot to thank you for. But in general, you're the wizard when it comes to crypto, and I trust you, right? And leading into just the first topic, look at the market right now. I mean, it's pumping. Is it pumping? Am I supposed to? Because I've been on the sidelines with you because we kind of expected some decline, right, over the last bit. But Bitcoin's up, Ethereum's up. I'm wondering what's going on here. If it's a bull run, are we out?
That's what everybody wants to know, right? That's $1 million question.
Yeah.
Yeah, Ethereum's up about I don't know 80% in the last 5 or 6 weeks. Bitcoin's up about 35%. Some projects like Polygon are up as much as 275%. That's pretty impressive gains considering this macro environment we're sitting in. But with that being said, it feels like a typical bull trap to me. I'd be honest with you. We were overdue for a relief rally because there was so much brutal downward selling pressure over the last couple months. We were overdue, and you got to remember, bear markets don't go straight up; they have corrections, and bull markets don't go straight down; they have corrections as well. So, if I were to guess, due to the macroeconomics environment we're sitting in, this feels like a bull trap. I don't see, but the Fed's continuing to increase interest rates. That's soon for sure to demolish the housing market. And the
Yeah.
Fed's already said that they don't care about that. They're willing to devastate and break things in order to get inflation down. So I think we have a little more pain ahead. And you can see too, Bitcoin as it pumps right around when it hits $23,000, $24,000, it comes back down to 22 and 21.
It's
So
some
let's,
resistance. Yeah, I see that.
yeah, yeah.
So you did mention a couple projects, right? Like Polygon up 275%, right? I mean, what's the deal with that? Really though, like 275 is a lot.
Yeah.
I mean, should I
Yeah.
jump in? I'm wondering, right? I'm having FOMO a little bit.
Yeah, no. So here's the deal with that. Polygon's a great project, but they have an amazing marketing team, and they're teaming up with some pretty big industries like Disneyland, Disney World. They're making all kinds of partnerships, corporate partnerships. And as far as layer two solutions, it seems to be ahead of the curve. But I wouldn't jump in now. You never want to jump in anything as it's up 275%. Most likely there'll be a correction on Polygon and there'll be a better entry point down the road. But I could be wrong. But
Yeah. Let me ask you. So the Fed's right, monetary policy and quantitative tightening affecting the crypto markets, right? How
yeah.
how is that? Like, what's going on? What's the big picture there?
Yeah, so the Feds with historically high inflation rates,
Yeah.
which was a consequence of the pandemic, and the fact that the Feds gave out somewhere between 7 and 9 trillion dollars. That's where inflation is coming from. That and supply chain shocks from China, Russia, and Ukraine.
Okay.
But they're historically high. We're at like a 40 or 50-year high on inflation, and that's the Fed's only concern right now. They don't care about anything else. They're willing to demolish the stock market, crypto market, housing market, bond markets, whatever it takes. And they've said this,
Yeah.
whatever it takes. So their only concern is getting inflation down. So what the only tool they have in their toolbox is quantitative tightening, which means increasing interest rates, which takes money out of the ecosystem and ultimately affects everything. Your credit card, your mortgage, stock market, crypto, it's all affected.
I've seen it, man. I felt it myself, right? I mean,
Yeah.
it's pretty crazy what's going on. You can see it in simple things like gas prices and and all of that. But I like you said, it should be considered a bull trap, right? Just because of where the economy is right now, right? I mean, they haven't officially announced a recession, but what do you think about that? Like, what's coming soon, in your opinion?
Uh, Paul, you know me. I'm a macroeconomic guy. Most of my investment theses come from the studying of macro environment and history of macro environments. And I imagine 20, 30 years from now, we're going to look back on this time in history, and it'll be one of the worst economic conditions we've ever seen. People don't realize this is the beginning. This isn't the end, right? Like, this is brutal. You can compare these times to like the 1930s, 1940s, or 1970s, where out of control inflation, and really the Feds have been unsuccessful at decreasing inflation at this point.
Yeah.
And if they're willing to break things, it's going to get way worse. I mean, that's just my opinion. I don't. This doesn't stop. This doesn't stop until inflation comes down. So
Yeah, and I have to agree with you on this, like, wholeheartedly, because you look at it and it's like it's almost like people don't even know yet, right? A lot of society is just still kind of spending the same way, but now what we've kind of unveiled is they're spending it on credit a lot now, right? And it's just they're living that same lifestyle of all the inflated money that the pandemic gave away, right? But it hasn't hit.
Paul,
So
you brought up a great point. Credit consumer credit usage is up, and that's usually a leading indicator on where the economy is heading,
yeah,
and that's not good. Another point you brought up that I thought was really good was, so in 2021, guys like me were screaming to anybody who would listen that in 2022 inflation is going to be a nightmare.
you were
And
screaming to me.
that's right. And
Yeah.
the Feds, and even President Biden, he kept saying, no, it's quantitative. And I remember watching this interview where they asked President Biden about, is inflation going to be a problem in 2022? And he laughed, almost as if the interviewer was stupid. But now we're seeing it, right? So and here's the thing. I don't know about the president. I don't know what his economic background is, but the Federal Reserve, they're all PhD macroeconomic guys. Like, they know what they're doing. But so one of two things is either true. Either they were lying to you in 2021, or they don't know.
Yeah.
What are the chances they don't know?
It's kind of hard to believe.
And we're looking at that exact same situation right now, Paul. So throughout history, the definition of a recession is two quarters back to back of negative GDP, gross domestic product. We have now officially hit that. And just days before the numbers came out, the White House came out and said, oh, we have a new definition for recession. So therefore, we're not in a recession. So we're seeing a behavior here, a history of behavior. Now, you got to imagine the government right now, especially the Democrats, do not want to announce a recession right before an election time. Because
that's why they're redefining it, right? I mean, it makes all the sense in the world.
That would be my guess for sure.
Yeah, and it doesn't take a rocket scientist to figure out what's going on with the economy and everything. So,
yeah.
Well, kind of bringing that back to crypto, right? Because that's really what we're here for,
right?
What should investors look for as far as signals go to know if we're out of the bear market or not out of it, and we're just in a bull trap? Like, what kind of signals should we look for?
When the Federal Reserve pivots, which means their next meeting is in September. You'll know when they pivot, which means the last two interest rate hikes have been 75 basis points. If they come down to 50 basis points and say something that sounds like we're seeing improvement in the inflation numbers, you're going to see money start coming back into the investment ecosystem, especially crypto. Crypto is hit the hardest because it's the most riskiest asset.
Yeah.
So if it comes down faster, that means it'll go up faster as well. So I think personally, if I were to guess, and I could be wrong, I've been wrong before, right before elections, which is September-ish, they might start to pivot in order to preserve, keeping Democrats in office. If that happens, that's probably a good sign if it doesn't happen then, I think early, like maybe February, March of 2023, they will have to pivot. If they don't pivot by then, they will have to pivot. And the reason why is as they increase interest rates, mortgage rates are going up. For example, the mortgage rate just a year and a half ago-ish was 2.5%. Now it's like 5.5%, 6%. So that doubles your mortgage payment on the same value of a house. If you're buying a $500,000 house, if at 2.5%, your mortgage payment was $1,500. Now it's $3,000. If they stay on this path until early 2023, you're going to see a 10% 30-year mortgage, which will make that same house a $4,500 mortgage payment, which is 3x what it was a year ago. You can see how that's going to be devastating for the housing market.
For sure.
Yeah.
Yeah. And it's already, you can already kind of, people are already starting to have that energy about it, right? They're just, you know, a lot of like flippers and a lot of my buddies who own homes, they're concerned. So it's pretty scary waters right now. I mean, with your advice, I've been on the sideline for quite some time now with all my crypto and pretty much everything, just watching things pan out. I mean, it's kind of scary times. And I think that if you're like forcing in and getting FOMO and kind of buying in on the hike right now, you're just being an uneducated investor, really, right? Because that's what a lot of people do. I notice they just jump in when it starts rising and then they sell when it crashes.
Paul, you nailed it. So education is key. Educated investors know exactly what to do in these moments, but retail investors who just don't really know much about what they're doing within investment circles, they all do the same thing. They wait until there's all kinds of hype. Like when Bitcoin's at $60,000, they're jumping off buildings to buy more out of FOMO, fear of missing out. But so they bought the top, right, at $60,000, and then they ride the wave down. And then when it hits like $30,000 or $20,000, they sell out of fear. So they bought out of fear and they've sold out of fear.
And they lose.
And this is actually very natural because you're born with an instinct of fight or flight. This is what kept you alive 10,000 years ago when you're running away from, bears and stuff, right? It's natural. You're born this. It's in your DNA. But as an investor, you have to do the exact opposite. All the best investors in the world, they never buy at the top. When there's hype, when they see hype, they get fearful and they sell.
Yeah.
When they buy is times like now when people are terrified and the prices are demolished and there's blood on the streets. Billionaires are made from buying when people are fearful. And that's the truth. Yeah.
Yeah, it makes a lot of sense too.
Yeah.
Yeah, man. Well, hey, man, some gem information in here. Seriously, this is some good stuff. And I appreciate you taking the time. I'm looking forward to many more of these that we're going to be putting out daily, maybe sometimes 2 a day. Just depends on what the market gives us, right? Yeah. I mean, guys, if you find any education or entertainment in watching us today, just like and subscribe below. It helps us help you. Remember, we are not financial advisors, so please do your own research. We truly appreciate you being here. Jason, thank you, man. I look forward to seeing you tomorrow, man.
Paul, as always, I appreciate you, man. We'll see you tomorrow.
All right. See you, man.